All right. Well, welcome everybody to today's webinar. My name is Jason DeBono. I'm the Vice President here at NuView Trust Company, and I'll be leading the discussion on UBIT and UDFI, which is one of my favorite topics to talk about because it means that people are getting to some pretty advanced strategies around using self-directed accounts. And as kind of a nerd in this industry, I love to see the creativity and I love to see leverage as a tool. And so we're going to talk about what that means and what UDFI and what UBIT are, their application, how they work. I'm sure today will probably engender lots of questions, and so I would encourage free-form dialogue. We do have too many people on here to unmute people, but what I would ask is that you use the chat function or the Q&A on your screen there and just type your questions out in real time if you don't mind. I will take some breaks in between slides and I'll read through those and get those answered so that we can address them, generally your questions or other people's questions. And I recognize that when we talk about things like taxes and structures and strategies that are more complex, it can be a little harder to follow along. So I'll do my best to speed up and slow down and try to cover this in good detail, but also not leave anybody that may not be as familiar with what we're talking about behind. So with that said, let me kind of get us moving forward from a presentation standpoint. So I want to start by saying I am not an accountant. I am not an attorney. I'm not a CPA. I do not work in that business, nor do I put myself out there to be or suggest that I am one of those licensed professionals. I've been in this industry for over 15 years. I've seen it a lot. I've dealt with it. I understand it very well. But every single tax situation is unique. And there's nuances that presentations like this are not even designed to cover. So we're going to talk in general terms, use general examples for general concepts. So if you're looking for more deliberate or specific information, be sure to talk with your attorney, your CPA. If you don't have one or you're looking for someone with some UBIT understanding, let us know and we can make some referrals to people that we know that may be a little bit more versed in this topic. So NuView Trust Company, to understand our role, we're not here to tell you what to invest into or tell you what strategy is best. We're here to custody your retirement account. So we're here to let you have choice and we're let you to have that freedom of choice. But what you invest into is your decision and yours alone. All of the accounts we custody are in fact self-directed. So we don't provide tax, investment, or legal advice in any way. We've been in this business for 17 years. We've got nearly 50 employees in our South Dakota compliance office, as well as our Longwood, Florida administrative office. We're nearly $1.5 billion of custody, and that's made up in a variety of assets, but certainly real estate is a strong bit of that. And our business model is to be simple, available, and responsive. So what is UBIT or UDFI? So let me start by saying they are taxes that were created outside of IRAs, but their application has since been added to IRAs. So UDFI and UBIT are two separate taxes under the same tax code. You can find them in publication 598, and they are designed to really, UBIT is a tax, is unrelated business income tax, and UDFI is unrelated debt financed income tax. And they are designed to be taxes that would apply to tax exempt organizations. So as I said, UBIT and UDFI were not built with IRA code. They were built in other areas. And I'll give you a very common example. If you take a nonprofit, and it really doesn't matter what it is, I could use our Share the Love, which is a nonprofit that we run. Share the Love is a nonprofit organization. What it does is not taxable. So as it takes on income via donations and other things, and it expels those out into the marketplace in the form of donations, et cetera. That entity is tax exempt. However, if we decided to open a restaurant that Share the Love invested into, the IRS says, hey, wait a minute, the income that Share the Love is generating is really business income. It's not tax exempt income like donations, it's business, operational business income. And so we're gonna tax those dollars because if we don't, they're gonna go untaxed, right? UDFI has nothing to do with the business side of it, but it says if you're going to use leverage, meaning you're going to go out and borrow money outside of the entity. So this Share the Love tax exempt organization is going to go out and buy a building with leverage, right? Or an IRA for that matter. The IRS says, well, that building is fine to own, but if you buy it with leverage, you're really taking non-tax exempt money, meaning money that exists outside of the account, and you're using that to generate profits inside the account. So we're going to tax a portion of that based on the fact that you're using non-IRA money to generate money into the IRA. And I'll talk through that in better detail. So just understand first that these are common taxes. Most people aren't familiar with them as a general rule, but they're common in the sense that they do have application. And a lot of accountants file these for nonprofits all the time, depending on what type of work they're in. So now that we kind of understand UBIT as its own tax and UDFI as its own tax, we're going to talk about them separately. And one of the things that I want to make sure to clarify is in the self-directed IRA world, people actually use this generally very incorrect. Most people use UBIT as a surrogate for UDFI. And I want to make sure that we don't combine those two things, that they are separate. But a lot of times people say, oh, I'm going to go invest into a real piece of real estate with leverage. I'm going to have to pay UBIT. And not to be very particular about terminology, but they're two separate taxes. And there may be some applications that are different. So UBIT specifically applies to business income, i.e. this restaurant, right, owned up by a nonprofit, whereas UDFI is very specific to debt leveraged income or debt financed income as UDFI. So we say UBIT and people use UBIT as the term, but understand it is a separate application from UDFI. Let me just kind of pause there. I don't see anything coming in yet, but I got a feeling we'll get some questions here as we dig into the meat. So UBIT is unrelated business income tax. Again, the easiest example is a bit of business income to a tax exempt entity, right? Owning a restaurant or generating revenue from that business into a nonprofit, or an IRA owning an operational business. So the first thing that I want to talk about that comes up frequently is there income or business activity if I'm a real estate investor? And this is a very, very, very dark gray area. In my 15 years, in our 17 years, in our tens of thousands of accounts that we've custodied, we've never seen a client have an issue in the gray area of business income for general real estate investment. In the industry, I've never come across a case, and I'm unaware of any sort of activity in a real estate environment outside of debt leverage that has engendered the UBIT tax. So that said, we still need to understand it may have some application. So one of the common questions that we get is, if I'm a real estate investor and I flip 5 homes in my IRA, is that considered a business? If I flip 10 homes, 20 homes, 50 homes, 100 homes? There is no definition. Remember, UBIT was created prior to IRAs, so it wasn't created with IRAs and real estate in mind. It was created for nonprofits. Its general application is income from trade or business regularly carried on. Most people would say, from an advisory standpoint, that in the real estate space, it's very hard for them to extend that trade or business regularity to you as an investor inside your IRA. Right? This same issue comes up a lot with day trading, right? There's a lot of people that say, well, if I day trade in an IRA, can I subject the IRA to UBIT? And the answer is yes. Whether it will ever apply or anyone will ever know exactly what it takes is uncertain. But if you day trade in your IRA, technically it can be considered business activity. The key is it regularly carried on? So I'm not here to tell you not to worry about real estate as a business. I'm here to tell you that it's highly unlikely, but just because it's unlikely doesn't mean you shouldn't be aware of it. The key is that it's unrelated to the exempt function. Well, one case could be made that the job of an IRA owner is to invest the money. It's not a stretch. And because real estate is permissible in an IRA, it would be very hard for them to say me buying real estate could be considered a business when you're telling me it's an asset class I can go invest into, right? So there's certainly some coverage there. Generally, it's defined as trade or business income, selling goods or performing services. So we see this a lot. So one of the things, if we take real estate off the table, one of the areas where we see this commonly come up is UBIT's application in private equity. So there's a number of passive investments that probably don't have UBIT implications, but we have a lot of clients that invest into operational businesses. So if I invest into a restaurant, fund or into a restaurant, or I invest into a hotel that's operating, and there's not just real estate income, right, or real estate in terms of building, but there's actually real estate income from the operation of a hotel. I think we'd all agree that's not passive rental real estate, that's a business, right? So does UBIT apply in that scenario? And the short answer is likely. And I want to kind of clarify what this means. So this only applies if the entity you're investing into is a pass-through. If you're investing into a C corporation and the corporation is paying tax on the income at the corporate level, UBIT does not apply to your IRA regardless of the type of income it is. This is why UBIT doesn't apply in the stock market, because all the publicly traded companies that are publicly available for IRAs to invest into are all C corporations. They pay tax at a corporate level, and then they distribute out any money that's distributed back to you in the form of earnings is already taxed, therefore UBIT doesn't apply. But if I take that same account and instead of investing into, let's just say, Microsoft, right? But instead I invest into a computer company that's private, right? It's a new computer technology or chip manufacturer, whatever it may be. If they're generating business income, i.e. creating products and selling them or selling goods and services, and they send money back to my IRA, then likely that money is subject to UBIT. Now, if the entity itself pays it, it's not applicable. But if the entity doesn't pay it at the corporate level and it's passed on, then it has to be paid at the IRA level. So understand, it's not double taxation. It's not taxed at the entity and taxed by the IRA. It's simply not taxed at the entity level. Therefore, the tax is caught at the IRA level. Let me pause there. I've seen a question that comes through. Someone asked about a replay of this, and yes, we will make this available. It does hang on our website, and you can go and access that at any point. So as we look in this into UBIT, we need to understand that its application is business income, goods and services, back to a tax-exempt vehicle, right? I'm seeing people raising their hand. We're not going to unmute. So if you do have a question, use the chat functionality and it'll show up on my screen and I'll get that answered. Yeah, unfortunately, we have a significant number of people today and we're going to be unable to do that. So the other thing about UBIT is it applies to both IRAs and qualified plans. So if you have a 401k or an IRA, its application is the same. Remember, the premise is tax exempt organization. Qualified accounts versus IRAs are both considered tax exempt organizations. We pause for a question. It says, if the business is a sub S, does it apply in my Roth self-directed IRA? So this is a little bit of a trick question. IRAs cannot invest into S corporations. That is not an IRA rule. That's an S corporation rule. So if I'm setting up an entity as an S corporation, I cannot have any of my shareholders be IRA accounts or retirement accounts. Again, not an IRA problem, that's an S corp problem. So in order for an IRA to be eligible to invest into it, if it's a corporation, it has to be a C corp. If it's taxed as any sort as a S corp, then it cannot have IRAs as investors. So again, kind of a trick question there. Going back, I see people continuing to raise their hand. I can't do anything for that. So if you do have questions, please type them into the chat functionality here, and I'll get them read aloud. But if you're raising your hand, it'll show up on my screen. But like I said, there's just too many people to go back and forth. All right, let's keep moving on here. Thank you for the questions, and I'd encourage you to keep them coming. All right, so when we talk about UBIT, let's talk about exclusions and deductions. So one of the things, and I'm going to talk in general terms, not knowing necessarily where your knowledge of self-directed retirement accounts lies, But when we talk about IRAs, as a general rule, one of the things that when you buy investments is you don't have deductions. Some of the tax benefits that exist in some asset classes don't apply in IRAs. So it doesn't mean there's no benefit to own it in an IRA. It just means I can't take, for example, depreciation if I own a piece of property in an IRA. But the reason I can't take depreciation is it's a deduction against tax. Well, if I don't have tax, I don't need deductions. So it's actually better, right? A deduction is a reduction, whereas an IRA is an elimination. But when we talk about UBIT and UDFI, it reintroduces back deductions and exemptions. So as we go forward, if you are going to be in a scenario where you may have a UBIT or UDFI tax, keep in mind that you can use deductions to offset that tax. So again, we're not going to get all the way into all the details, but I just want to talk about some of those. So there are deductions that can apply. So you get a lot of the standard business deductions would offset your business revenue and taxable income. Expenses must be approximately and primarily related to the business. So I can't write stuff from another business. Expenses, depreciation, and other items must be solely to the conduct of the unrelated business activities that are actually deductible. You can carry forward some net operating losses. So if you invest into a restaurant, for example, and it loses money 2 years and makes money the third, you can carry forward those losses, which is very nice. There are certain charitable contributions that you can take a look at, but you also get an automatic $1,000 deduction. So if I invested into a restaurant and they sent me $1,000 this year as my dividend, I actually wouldn't have any UBIT tax due because I get an automatic $1,000 deduction right off the top. So that $1,000 would net to zero. If it nets to zero profit, no tax liability. The other piece of this is what are excluded from UBIT. Right? Royalties are not considered business activity, so royalties are considered excluded. Rents of real property, right? So personal property rents beyond 10% are not excluded, but that generally doesn't apply in IRAs, but it does apply in the overall UBIT world. The other thing that's really interesting here is it excludes any sort of indebtedness prior to 12 months. And we're going to talk about that in our last slide in techniques and strategies to reduce our tax liability, but they really only have a 12-month look back period as it relates to indebtedness. Gains and losses from the sale or exchange of property can be excluded from UBIT as well. But again, we're not talking about UDFI, we're talking about UBIT. Gains and losses from real estate, if they're debt leveraged, will be applicable. So again, we're generalizing these. I think the moral of this slide is very simple. If you're going to invest into an operational business and you're going to subject the IRA to UBIT, it is not UBIT based on how much they send you back. It's UBIT based on how much they send you back, less any eligible exclusions and deductions. Then we'll calculate out our UBIT. And we'll talk about that in an example on a slide here. I see quite a few questions coming in. Let's see here. It says, does UBIT apply to profits made by an IRA-owned vacation rental property? This would be, so first thing is, when we talk about UBIT, UBIT has nothing to do with whether or not the property's debt leveraged. If the property's debt leveraged, then UDFI would apply, right? Whether it's short-term or long-term rental, it doesn't matter. As it relates to an IRA, it's possible it could, but it would fall into that gray area. The question is that short-term rental, right? Does it meet the necessary requirements to be considered exempt? Because, right, the IRS does list rents of real property as an exemption. So as a general rule, you should be okay. The question is, could the IRS suggest that operation of a short-term rental is more of a business activity than it is a passive real estate activity? That's yet to be determined. I've not seen any cases of that. We have lots of clients that own short-term rentals in their IRA. None, to my knowledge, are paying UBIT on it. So I don't believe it automatically applies, but I won't say no just because the IRS could only make it applicable if they proved it was more of a business than passive real estate. How about buying personal property via your self-directed IRA? Is that taxable? Can you create a trust instead of a C Corp? So creating an entity generally doesn't avoid the taxation, right? The IRS is going to step in and say, if the IRA owns an entity and that entity owns something that is taxable from a UBIT standpoint, by extension, it would apply back to the IRA. We'll talk about some blocker corporations and things at the end. As far as personal property, it would depend. But as a general rule, yes, UBIT would apply. So because that would fall under selling goods and services, right? If I buy a piece of lawn equipment and sell it, right, that's not considered a passive investment. That's considered active, right? I'm selling a good or service. Therefore, UBIT likely would be applicable. Now, whether or not there's ways around it and whether or not it's in the gray area, that's between you and your legal counsel and your tax accountant. But typically, as I can say specifically that leasing, any sort of income derived from personal property is going to be subject to UBIT. And that's because rents of real property are excluded, but not rents of anything else. So if I were to go out and invest in or go participate in equipment leasing or anything generating profits off the leasing of equipment, right, which is kind of like rent for a piece of construction equipment, that would be subject to UBIT as a general rule. Now, whether or not I can diminish it to zero using write-offs and other things, I just don't know, because the world of asset classes for stuff like that is so broad. But yes, if you're going to invest your IRA into anything that's not considered a passive investment, you very well could be subject to UBIT. What about investing into leverage LLCs that operate a real estate class like offices, et cetera? So as I mentioned, that question is really not a UBIT question, that's a UDFI question. If the entity has leverage and my IRA is benefiting in some way, shape, or form from that leverage, meaning the earnings are proportionate based on revenue from both principal and leveraged earnings, then yes, UDFI would apply, but let's hold that until we get to the UDFI portion of it. All right, is it possible to invest several IRA funds into a partnership LLC that acquires and rents a property? The answer to that is yes. You could have 8 or 10 or 100 IRAs invest into one entity, and that entity can in turn buy property. If it's buying passive real estate or passive investments, then you would not have any UBIT issues unless you're taking on debt leverage. If you're going to go invest that LLC into operational businesses, then UBIT very well could apply. Syndication investments through self-directed IRA, UBIT or UDFI? General rule is UDFI. I'm making an assumption that the syndication is using leverage, but as a general rule, they are. If they're not using leverage, and we have seen lots of syndications that are cash-on-cash deals, then UBIT does not apply. UDFI wouldn't apply. UBIT could potentially apply depending on the syndication. If there is an active operational business part of that syndication, maybe UBIT would apply on those specific earnings. But generally, when we see a lot of what we see we do a ton of syndication work, what we see in most syndications is they're real estate based, they're considered passive, so the rental income is not subject to UDFI or UBIT, UBIT. But what does happen is the leverage piece is what triggers UDFI, right? So like I said, it's very likely UDFI will apply in a syndication, but not UBIT. Notes and mortgages subject to UBIT. As a general rule, no. The income received off a note is considered passive and therefore not subject to UBIT as a general rule. You do have that issue where you could be, if the IRS can prove that you are running a business versus making a passive investment, that could trigger it. But again, that's a pretty big stretch for the IRS. So yes, making loans and putting them out as debt does not subject the IRA to UBIT or UDFI. Now, I will say, depending on, you can't take what would look like an equity position that would be subject to UBIT and convert it to debt automatically and avoid it. But for example, if I invested $100,000 into a business as an equity position, and it was an operational business, the profits I earn are subject to UBIT. If I took the same $100,000 and wrote a promissory note to that business at a rate of 8%, I would not be subject to UBIT because I'm simply making passive returns. It's not subject to the earnings of the business. However, if I tried to disguise my equity position in that business as a note, and it was a note that read something along the lines of $100,000 and I get 5% of all profits of the business, the IRS would make a pretty easy case that UBIT would apply, because I'm not generating passive income on my note, I'm generating the active business, right? So you have to be careful in how you term those notes if you are investing or loaning money to an active business, especially if you're trying to avoid UBIT, because you want to make sure that you're not thinking because it's under the debt umbrella that it's automatically exempt. It has to do with how you're earning those profits. Is the $1,000 deduction over the life of the investment? The answer is no, it's $1,000 annually. Is a REIT in an IRA fully exempt from taxes? Generally, REITs do not subject the IRA to UBIT or UDFI because they have certain requirements that they're meeting, is my understanding. I've not seen a scenario where there's debt leveraged issues inside of a REIT specifically, but if it's a limited partnership or some other structure, then typically, yes, it does apply, but as always, consult your own counsel on that. I'll take these last two and then we'll jump back over here. What about investing in self-storage, where in addition to renting units, also renting trucks, selling packing materials, etc.? It would depend on how it was structured, but if you made an equity investment into an entity, let's just say an LLC that was called self-storage, but it generated its profits based on selling trucks and packing materials, then that would be subject to UBIT. Now, whether or not you could separate those two things and say, this bit of profit was derived off the real estate portion, which is considered passive, therefore not subject to UBIT. However, this small portion, right, that was from truck rentals and packing boxes and stuff, that piece of it is subject to UBIT. K1 documents have a UBIT box. So when you make an investment into an entity, it is really the sponsor of that entity's responsibility to determine what income may be subject to UBIT. So just because you make an investment doesn't mean all the profits are subject to UBIT. Remember my example of Share the Love, a nonprofit organization owning a restaurant. By owning a restaurant, I'm only subjecting the income from the restaurant to UBIT tax. It doesn't mean all of the income of Share the Love is taxable. So if you're invested into an entity and that entity has 3 or 4 streams of income, you only need to pay UBIT tax on the streams of income that qualify or generate UBIT liability. If 3 of those are considered passive real estate and 1 is considered active business, then it should be carved off, and your K1 should clearly articulate that only that portion is subject to UBIT. If the IRA invests in a mobile home park or multifamily, are those considered active businesses and subject to UBIT? So I'll answer this with a big asterisk, talk to your own legal counsel. As a general rule, my understanding is they are not. They are not, because they are still considered passive businesses, and the primary source or the exclusive source of all revenues are rents on real estate, right? Rents on real property. So it's exempt. Now, if they were doing other things, it certainly could subject it to UBIT. So, for example, if they took on, if they were monetizing the internet or the cable, where that was actually a profit stream, not just break even or a way to enhance their real estate, then maybe a small portion would be. But again, as a general rule, if the profits are derived from rent of real property, they are exempt from UBIT. Let me jump back over here and make sure that we're keeping on track. Keep the questions coming. They are, I've got a couple here I'm just going to hold off on, but I appreciate the questions, and I know there's probably lots more, and we'll continue to get to them, but I do want to keep moving through a slide or two. I've only got a few more slides as far as detail, but I want to give you some examples here and walk through that. So when we talk about unrelated debt financed income, the name of it says it all, right? Debt financed income. Income from debt leveraged real estate. So if you don't have debt leveraged real estate, this does not apply to you. Just like UBIT, if you don't have income from active business activity, you don't have UBIT. UBIT applies dollar for dollar, meaning every dollar of every dollar of income that falls under UBIT is subject to the tax. UDFI is only subject to the pro rata portion of income as it relates to the debt ratio. Now, I'll give you an example on the next slide that's actually right out of IRS code. But in very general terms, if I go out and take on my IRA, whether I do it through syndication or I do it directly, doesn't really matter. But if I go out and make an investment that's 50% down payment, 50% leverage, then as a general rule, 50% of all of my income, both annual and proceeds from sale, are subject to UDFI. Now, I can write things off to lower that number, but that's just the starting premise. So if you buy a house in an IRA with 50% leverage, only 50% of the rental income that comes in above your expenses is going to be subject to the tax. So make sure you're factoring that in, and we'll talk about some strategies to that as well. UDFI applies to IRAs, but there is an exemption in 401k plans. So we offer a plan called the Solo Qrp. It's basically a 401k or solo 401k for owner onlys. That plan is amazing because it eliminates UDFI. So we'll talk on our last slide, but if you're going to be investing into something where UDFI applies, syndications or other things, it makes tremendous sense to set up a solo 401k, solo QRP if you can qualify, because it's going to eliminate that responsibility to file for UDFI. So let's talk about what this looks like. So the way that it works is very simple. It is the average acquisition indebtedness divided by the average adjusted basis times the gross income equals UDFI. Now remember, UDFI is not the tax. UDFI is the unrelated debt financed income. We'll take the UDFI and determine how much tax applies, right? So I'm going to use this. This is from the IRS.gov. This is their example. An exempt trade association, now you can tell by this example, being that it's from 1971, certainly predates even IRAs, which didn't come out until 1974, right? So in 1971, a tax-exempt entity owns a piece of real estate that produces $10,000 of gross rental income. The average adjusted basis of the building for 1971, so the 12-month period, was $100,000. And the average acquisition indebtedness with respect to the building in 1971 is $50,000. Accordingly, the debt basis ratio is 50%. Therefore, the unrelated debt financed income with respect to the building is $5,000. So you would take your first calculation is the division to get to 50%. Times the gross income of $10,000 gives you UDFI of $5,000. Now, when I take this to the next slide, we're simply taking this at worst case scenario, meaning we're just taking this straight $5,000 and running it into their tax formula to understand how much tax we owe. Keep in mind that the $5,000 is only the UDFI amount. I can take a $1,000 annual deduction against that. I have other expenses, right, that may apply, or things that I can write off in that amount. So I'm giving you this example at the most conservative, simplistic, top level, but keep in mind that that number can drop, depreciation, other things that can offset it. If you take the $5,000 of income and you just follow the numbers in the bottom, the 0 to 2550 is 10%. So that's where that $255 number comes from. Plus, we take the next balance, which is 5,000 minus the first bracket there of 2550, leaves us 2450. It's taxed at $255 plus 24% of the amount over 2550, which is 2450. That number is $843. $255 plus $588. So that means you can leverage this property. Again, worst case scenario, 50%, generate $10,000 of rent, and your liability for UBIT would be $588, or I'm sorry, $843. So in the grand scheme of things, that's 8.4% tax on $10,000 of profit. It's a very low amount of tax when you think about it, because you actually earn $10,000, you're only taxed on $5,000. Now, the question that you have to look at is, what would it take to eliminate this tax? Well, I put $50,000 into the deal, right, to make 10 grand. That's a 20% return. If I pay out $843 and round that up to $1,000, I made $9,000 on a $50,000 investment. If I wanted to keep it all, I would have to pay cash for the property. Means I got to put $100,000 into the property. And that extra $50,000 of investment only saves me $843 of tax. Well, using those numbers, we'd make that trade-off any day of the week, because you would never lay out $50,000 more to simply make $843 more. Because remember, owning it cash versus leverage doesn't generate any more rental receipts. So it's a $50,000 investment for $843. The value on that doesn't work. You're not going to get a return on your investment. So when we talk about UDFI, it really, as a general premise, as long as it's a good deal, meaning the property's generating good revenue, it makes great sense to utilize leverage if all things are considered from a tax standpoint. So let me pause there, right? And let's take, we've got some more questions coming in here. Will the UDFI appear in the UBIT box on the K1, though UDFI was a form of UBIT? Yes. So I'm only segregating UDFI and UBIT for the sake of discussion so people understand the difference in application, because it could apply in the same IRA in two different ways, right? I could have an active business investment that triggers UBIT, and I could have an active real estate investment with leverage that triggers UDFI. But it will show up on the same K1, and it'll actually be paid on the same tax form. When it says, are these still outdated numbers? So the numbers here of the tax rate, so far as I know, haven't changed. So the numbers that you see as far as what the tax liability is still the same. They don't tend to move these rates frequently, but that said, I'm not in the individual calculation side of it. It's very well they did change, and I just haven't either made myself aware or been made aware. So make sure you take a look at that with your own tax professional. Interest incomes from purchasing notes would be subject to UDFI as a question. We already talked about that. Income from note investments as a general rule is not subject to UBIT or UDFI. And I gave you the example where if you try to disguise an equity investment as a note, it could be subject to UBIT, right? Or UDFI. But as a general rule, true passive notes are not subject to UBIT or UDFI. What if I use debt to invest in a non-income producing property such as buy and hold? Great question. So what it means is that on an annual basis, you will not have any income. If you don't have any income, you can't have any tax liability, right? Taxes are the result of making money. You will, however, when you sell that property, be subject to UBIT on the sale, or I'm sorry, UDFI on the sale. We're going to talk a little bit about this here in another slide, but the cool part is it's only based on the debt in the last 12 months. So if you bought a property today, right, 2020, and you held it for 10 years, never rented it out, or maybe you rented it but always broke even, you'd have no tax liability for 10 years. At the end of 10 years, when you sell it, your debt ratio is not the 50% that you bought it. It may only be 30% because of 9 years of the 10 years that you held it, you paid the debt down to 30%. And now your proceeds from sale may only be subject to 30%. The other thing is if you have losses along the way, you can carry those forward. So you can carry forward your losses to also offset your proceeds from sale. So certainly buy and hold has less UBIT, but obviously you have less income. One thing that I always like to share, and I want to make sure everyone understands a couple things from just true wealth building. I've learned this by really being around a lot of smart people, and I've learned two major things. Number one, that is that in order to build wealth, you have to minimize taxes. And so many people focus on investments and don't think about the tax associated with it. And so the more you keep of what you make, the more you'll build from a wealth standpoint. So I'm a big believer in that from a wealth strategy. And it's why I love IRAs so much, because they're such an amazing tax advantage tool. Even though we're talking about UBIT and UDFI, it's still such a small piece of the overall tax that you would be paying way more if you bought these same investments outside the IRA. You're typically not taxed more in an IRA, you're always taxed less. Some cases, in most cases, to zero, but when UBIT or UDFI applies, you've obviously got liability. The second thing is don't be scared to pay taxes, right? So these two things, while they seem mutually exclusive, are mutually inclusive. So it doesn't mean I want to avoid taxation because that's the only way to build wealth. It means I got to be cognizant of taxation as a strategy alongside building wealth. But I also can't be scared to pay taxes. And I have had customers that I've talked to that have said, I'm not going to use leverage because it's going to subject the IRA to UDFI. And I'm not an advisor, but I will generally ask the question of have you looked at the numbers? You're scared of a tax, the numbers. I'm only scared of a tax if my net profits are lower than they would have been otherwise. But I'm not scared of any tax that's going to take a little bit off the top and still leave me with more than I'd have if I did it in an alternative manner. So make sure that you're focusing on building wealth, using good tax strategy, but not being scared to pay taxes. How does UDFI apply to RMDs? There is no application. It's completely independent. You would still have to take an RMD and you'd still have to make a UBIT payment if it's applicable, or UDFI payment. So completely unrelated. How does it work with borrowing from banks, especially if property is in an IRA LLC? So this presentation is not on lending, the lending side of it. I'll answer the question in very short order. And that is, in order to get a loan in an IRA, right, not in a syndication or entity, but in an IRA, you must have a non-recourse loan. If you're investing into an LLC that you're managing, it must be a non-recourse loan. What it means is that the IRA owner and most family members cannot guarantee the debt on behalf of the IRA. So I can invest into a multifamily syndication with my retirement account, and it can have regular recourse debt so long as the people that are guaranteeing the debt are not me and are not my family members. But if I'm going to invest into property where I'm the guarantor of the debt, I cannot do that if my IRA is involved in the deal. It must be non-recourse. And we have a good handful of lenders that do it, 2 banks that do it nationally, and a lot of others that do it regionally. What about purchasing promissory notes within an IRA? What about purchasing promissory note in an IRA with a promissory note? A down payment is made and the note is paid over a 2-year period. My understanding that any leverage would subject the IRA to tax. So debt financed income doesn't say real estate financed income, it's debt financed income. So if you invested into a note and you paid 50% of the note value today and you made a payment to whomever carried the financing on the remaining 50%, then 50% of your profits, right, would likely be subject to UDFI, because UDFI is not tied to real estate. It's just its most common application. If you leveraged a piece of equipment or you leveraged any other investment in an IRA, you would subject it to UDFI. Do you have to file a 990T every year to be able to recapture the losses at the time of sale? Great question, and I'll answer that with I'm not 100% certain. I have had clients that have filed losses on a 990T declaring that they were doing that to be able to carry those forward. And I've also seen clients file a 990T when they sold a property and they carried forward all the losses on previous K1s, even though they didn't file a 990T. Our job as custodian, we're not in the tax side of it. So if a customer says, I owe this tax, here's my 990T, pay it out of my IRA, we pay it. We don't review them or read them. So I've seen it both ways. I don't know the answer to that. I appreciate the question. I'll probably go take a quick look just to see if there's anything concrete on that. But that's something you'd want to talk to your own tax professional on and find out. It's possible that you may get more time by filing a 990T. I just don't know how that works. All right, so let's move back to the presentation here. So let's talk a little bit about some considerations. So the first thing that I want to make sure everyone understands is UDFI is exempt from 401k and Qrp accounts, only for acquisition debt. So this does not cover UBIT. UBIT applies in IRAs and 401ks universally. And it does not apply to refinance debt, but it does apply to acquisition debt. So in a lot of these syndication deals, where they're going out buying something, maybe it's ground up development, it may be an apartment building, office building, self-storage, you know, and it's going to have debt to acquire it. The solo QRP account is such a great strategy. It's become relatively easy. When I say become, meaning there's so many ways for people, even that are currently employed, to qualify for this. It just simply requires you have some reasonable expectation of earning money through some self-employed activity. Well, in today's day and age, I mean, hell, I can put an eBay store up and make $5,000, right? I may not get rich doing it, but if I set that up, put a little work and effort, and it keeps me from being subject to tax, man, that's a pretty good strategy. So freelance work, consulting work, anything along those lines, if you already have self-employed income, that can be great. So just something to keep in mind. If you have a, you know, kind of what people refer to as a side hustle, or you can create a side hustle, this QRP account can save you a lot of money on taxes if you're investing into syndications and you know, other things that are using leverage. UDFI only applies to indebtedness in the last 12 months. So I will tell you a strategy that my dad is using in his retirement account. My dad owns 2 properties with debt. My dad could have bought both properties with cash, but by doing so, it's allowed him to use the money that he would have instead put into the deal to invest in other areas. 12 months and a day before he intends to sell either of the properties, right? He'll liquidate something that he's been investing for years, and he'll go take that money, pay the loan off, wait exactly 12 months and a day, and put the property up for sale. By doing so, when you calculate out UDFI and you look at the average indebtedness over the last 12-month period, it will be 0. If the average indebtedness is 0, then the tax liability is 0. So it is another great strategy, and we're something that we see a lot of IRA, especially those that buy, you know, that want to be in single family homes. So rather than buying 1 single family home cash, they'll buy 3 with debt. And over the years, they'll hold them for the long term. They'll collect as much income as they can, right? And I've seen people take the strategy of taking as much money as they've accumulated, paying down the debt or paying off the debt on property A, selling it, paying off property B, right? Waiting a year and a day, selling it, paying off property C, waiting a year a day and selling it. And they've just moved all 3 of these leverage deals into tax-free profits, right? So you don't have a lot of opportunity to do that on annual income, but the annual side of UBIT for rental property as a general rule is insignificant because of the $1,000 deduction, and because of depreciation and other things, you can generally minimize that down to dollars, as you saw in our example. UBIT can be reduced with a blocker corporation. Now, UBIT and UDFI can be reduced with a blocker corporation. It has to do with how much money you think the investment will generate. As you saw in my earlier slide, the tax rate gets progressively higher, right? It follows our American progressive tax system. So if you're going to bring in profits of 100 grand, right, you're going to end up paying 37% on a good portion of that. So what a blocker corporation does is it basically pays corporate tax. Well, the corporate tax rate is going to be lower on a certain dollar amount of UBIT or UDFI income. So if you're investing into something that you think is going to have a major payoff, right, this big investment over time or big payoff, then it is possible that you can, in fact, put that into a blocker corporation, and your IRA would invest into the C Corp, and then the C Corp would invest, and then the C Corp would actually pay tax as a true C Corp, and then it would distribute all the net profits back to the IRA. It is a very complex strategy. I won't say overly complex, but I will say very complex. And it generally is something that we see a lot more commonly in syndications, where you have lots of investors, where that blocker corp can be used to house 10 or 20 or 30 accounts. Typically, we don't see it on a one-to-one deal unless you're expecting some significant profits that are going to keep kicking you annually into these high tax brackets where that C corporation, blocker corporation makes sense. UBIT and UDFI is paid by the IRA. It is not your tax liability. It's your retirement account's tax liability. You will file it on a Form 990T. And so the way that works is you take your K1s and anything that you have that provides your earnings, your accountant will calculate out what the tax liability is. If there's a tax due or if you have a loss and you're choosing to file, you would send that to NuView and we would file it and pay it on your behalf. So for my dad's properties, his accountant takes his annual statement, which shows all the income, all the expenses, right? Their firm takes all of those property by property, calculates it all out, and then determines if UBIT or UDFI applies for those annual interest or earnings. If it does, my dad submits it to our office and we pay the tax via the 990T. If it doesn't, we move on. Right. So the other thing is it's up to each of you to be responsible if there are state and state tax or estimated quarterly payment considerations. That's something that you'll need to look into because every state and quarterly payment requirements differ. So you'll need to just look into that and see if they have any provisions as it relates to those for UBIT or UDFI. That is my last slide of info. We've got about 7 minutes left and I'll take some questions that are already coming, but I'll take a few more and we will be wrapping up right at 1 o'clock today. And I'm sorry, let me just get down. If the IRA invests into an ATM machine syndication, wouldn't that be considered an active business? Short answer to that is yes. And I'm saying this without knowing the deal, but as a general rule, yes. If you're generating profits that don't meet one of the criteria for being exempt, it would be. Now, I have seen deals, and I'm not speaking specifically to ATMs, but I have seen deals where they're structured as royalties. Royalties are exempt. So it depends on what you're earning inside that syndication. So if you're making money off the fees, right? The $2 that someone pays to take money out, or you're paying money, for actual business things that don't meet that criteria, it would be subject. But if your investment is into something and you're paid a royalty, right? You're paid a royalty off of the number of machines that are placed or whatever that may be, then you, if it truly qualifies as a royalty, it's not subject to the tax. So something to look into. It's hard for me to answer these questions in very specific terms just because we see thousands and thousands of deals. To give you perspective, we've had over 50,000 unique assets cross our desk. So they all look different. What about moving current investment held in traditional IRA at NuView into a QRP? Will this avoid UDFI? Yes. So if you have an asset that it won't avoid it annually. So anything that's already transpired in the IRA is still going to be subject. So if you own it in the IRA today, then you're going to potentially still have to do a calculation for 2020, right? Because the IRA generated income. If you can move that into a QRP, let's just say tomorrow, right? Then the income from tomorrow forward is not subject, but anything from January 1 to date would be. So yes, you can take existing assets if you qualify for the solo QRP and get them moved in to that solo QRP account and avoid it on a go forward basis. Just don't think that by doing it during 2020 eliminates any 2020 tax liability. Once it's owned in there, then yes, you're good. You're going to be good to go. Can I refi? I don't know what F&C real estate and not be subject to UDFI. I don't know what that question is. I'm sorry if you want to give me more clarity to that. Remember, the UDFI calculation is average indebtedness over the last 12-month period. So if you refi and your leverage ratio goes down, that'll just reduce your debt leverage ratio or indebtedness for the last 12 months. It has to do with whether or not there's still debt on the asset that's generating the income that the IRA is receiving. So if there's more to that, please ask. I want to get to that. The 401k/QRP does not eliminate UBIT, only UDFI. That is correct. And it's only UDFI for acquisition debt. So it is not going to avoid UBIT. If you invest into an active business that doesn't pay business tax, i.e. a C Corp, right, then the tax has to be paid at the IRA level. Yes, the presentation is recorded and it'll be hung up on our website. It's usually just a couple of days. You can find it on the blog section. All right, it says, if the ATMs are managed by a paid management company, so passive, is this still subject? I am sorry, but I cannot answer that. You're asking me whether or not you owe tax on a specific deal, and I just don't know. That's a little too deep into the structure of the investment. I will say this, it has nothing to do with who manages the income. It has to do with what type of income it is. So if it is considered non-excluded, unrelated business income to the IRA, whether it flows through a management company or not, it likely will be subject to the tax. Let's see, can losses from investment prior to moving from IRA to QRP be recaptured? Well, you would only recapture losses if you had a tax to capture them against. So if you had an IRA today that had an asset that was subject to UDFI and you moved it into a solo QRP tomorrow, and for the last 5 years you had losses. If you had losses in 2020, you'd have nothing to offset them against. If you had gains in 2020, right, that were subject to UDFI, then you could use your previous year's losses, but only if you had that gain. Once it's in the QRP, then you're not subject to UDFI, therefore you no longer need the losses to carry forward. All right, can you recommend tax attorneys to confirm tax liabilities when investing through self-directed IRA? Yes, if you want to reach out to our office and we can give you the names of some tax professionals or attorneys that you can talk to and see if they fit your needs, but the choice is up to you. My Roth IRA paid cash for a rental property. I borrowed against the property in the 4th year. I used the money to fix up another rental. I sold it in the 5th year, paid off the loan, and made a profit. All right, I'm going to do my best to answer this, and if I didn't get your question correct, let me know. So if I took property A and I paid $100,000 for it free and clear, and then I went and took a loan against property A, and let's just say a $50,000 loan, and I turned and bought property B, or I already owned property B and I used the $50,000 to fix up property B, it doesn't matter, and I sold property B at a profit. Property B is not subject to UDFI because there's no debt against property B. Even though I used the money, the debt is actually against property A. So I could sell property B tax-free because it's owned free and clear. Any income that property A generates, which is the property that has the leverage attached to it, is subject to the tax. Now, if you take the profit from property B and pay off property A, you're only going to be subject to UBIT in that year, because once you get into the next year, you'll be more than 12 months of having it paid off, and therefore it's no longer debt leveraged. So hopefully that answers that. It can be a great strategy, right? Borrow from property A, invest in property B, free and clear, make the money, no tax liability, pay back the loan against property A. And generally, as long as property only had some rental income and it didn't generate enough to have a meaningful tax liability that you couldn't offset with depreciation or any other means, your $1,000 annual credit already, you may not have any tax liability and can take advantage of the leverage. So I hope I answered that in the same manner. Maybe worth reaching out to our office if it's more complex than that. F and C equals free and clear. So if you finance free and clear, I'm sorry, and there's a whole world of stuff that gets into the investment side I just may not be familiar with. But if you take on if you refinance to pay off, if that's the exit strategy, meaning you refinance it and you make all of your limited partners whole, then the money that they earn would still be subject to UBIT or UDFI against any of that current year or previous indebtment for 12 months. If it's free and clear for a 12-month period, there is no tax liability, whether it's refinanced or not. You're welcome. I got a couple thank yous. You guys are absolutely welcome. Love being able to talk about the subject, and I love the great questions. Right. What if the debt is incurred at a later date, refi rather than acquisition? Well, I don't know the context of the question because there's some missing pieces. So I'll answer it this way. No matter when you take on debt From the debt point, you are subjecting that account to UDFI. Remember, the calculation is a previous 12 months of indebtedness, average ratio. So if you took on the debt, if you owned it for 12 months, but you only had the debt for 6 months, then it's going to be a smaller calculation because only 6 months of indebtedness will be reduced by 12 months of ownership. If it's in a solo QRP, that refi debt is not excluded. If you didn't take on the debt at acquisition, then you're subjecting the 401k, just like an IRA, to the tax. Remember, the look-back provision on an annual basis is the previous 12-month period's indebtedness. So if you had debt the entire 12 months of 40%, then you have 40% of your income is subject to UDFI. If you only had debt for part of it, right, and it was 40%, but you only had it for 2 of the months, then it would be reduced down and maybe only have 10% of that year's income is subject to UDFI, right? It has to do with how much indebtedness in the last 12-month period as a ratio. If your business that runs your solo self-directed 401k is forced to close and you have investments in your 401k, whereby you are a passive investor and the entity is an LLC, what are your options? Do you have to close the 401k? Can you transfer it to an IRA? Should you try to sell it before you transfer it to prevent UDFI? Great question. General answer. Typically, you can maintain the 401k even after the business is closed. You are not eligible to contribute to the account. But if you had a profitable business, or I say it didn't even have to be profitable. Let's say I had an eBay store for 3 years. I had my solo QRP. I contributed for 3 years. I bought some investments, transferred in my traditional IRA and old 401k, and I bought properties with debt. And then I shut down the business, and now I no longer qualify for the QRP. It doesn't mean that my QRP is void. It means that I'm no longer eligible to make annual contributions to it. So as a general rule, you can maintain that. Now, whether or not you do it into perpetuity, I don't know. I mean, the IRS may come in at some point, but my understanding is that you can maintain that for a long period of time. So if I had investments in that account that were subject to UDFI and exempt, I certainly wouldn't roll them over to an IRA unless someone told me I had to. That said, once I'm out of any UDFI exemptions and I only own passive investments with no tax liabilities, then I probably would roll it to an IRA because I don't want to maintain a 401k without the ability to contribute unless I'm getting some other benefit. So hopefully that answers your question. Yes, if you have questions on the 990Ts or other things from a tax perspective, let us know. We can refer you to some accountants and attorneys. Are you available for a consult regarding possible self-directed IRA purchases? So we don't, the short answer to that is maybe. We're not consultants. We will answer your questions as best as possible. Having been here a long time, I have lots of experience, but I don't do consulting work. I do work with clients. So if you do call our office and have something, I would ask that you start with our sales team. I do other stuff for the company every day. But if you do get to a question and you can't get it answered, there's some complexities maybe that that may require more experience than the person you're talking to has, then it's something I can talk through. But understand that if you're looking for advice, guidance, structure, that sort of thing, we'll talk in general terms, but we won't talk in specifics. That's just not our role as custodian. I understand 401ks are not subject to, so it says I understand 401k is not subject to UBIT with leveraged loans. So I just want to make sure that it's not UBIT, it's UDFI. UBIT will always apply in a 401k if you invest into have unrelated business income, but you are correct. UDFI with leveraged debt on acquisition is not subject. I don't know what you mean by does this apply to any states? UDFI and UBIT are federal taxes, not state taxes. So I'm unaware of any state application, but I don't understand the full context of that question. If we don't care about making any further contributions, can we just keep the 401k/QRP? Yeah, as a general rule, yes. Again, if you're looking for me to tell you the specific answer, I don't know. Could the IRS at any point, if they looked at it, say, you know, why do you have a QRP if you don't qualify anymore? Probably best to roll it to an IRA. There's no definitive guideline that says within X amount of time, all QRP assets have to be rolled over. I'm unaware of any guidelines around that. In fact, I have clients that have shared with me that they're maintaining their account at the advice of their tax counsel or legal counsel. I don't know their specifics, but I know it's been done. And I would consult with your tax professional about how long to maintain that account if you're not active from a contribution standpoint. Somebody asked the same question that was asked earlier. All right, I don't see any other questions. So let me take you guys down to the last slide here. If you do want to receive, I know a lot of you are already clients, but for those that aren't clients, and even for those that are, if you want to receive our e-guide, text or SDIRA to 48448. If you want to consult on the QRP side, meaning you want to talk to someone here about how that looks or what it takes to set that up, call our office. Make sure you let them know that you're interested in the solo QRP. They can walk you through the process, what it takes. The good news, as I mentioned, is it's not terribly difficult to qualify, but it will put a little more additional responsibility on you because QRPs operate a little differently than IRAs. And so whereby NuView as custodian handles most of the stuff in the IRA side, on the QRP side, there's some paperwork stuff that you'd have to take responsibility of. We can walk you through and talk you through that. It's a phenomenal plan if you're going to take advantage of the benefits, and certainly avoiding UDFI would be a great reason to set that plan up. All right. Yeah, there's a question in here about a passive investor in a certain state. I don't know how state taxes work. I'm in Florida. We are not taxed here. So I just have so little knowledge or understanding of any application of state taxes. If you reside in a state that has an income tax, I would encourage you to talk to your accountant about whether or not there's any sort of spillover from your IRA base tax, i.e. UDFI or UBIT, as it relates to the state level. So, well, we are about 3 or 4 minutes over, so we're going to wrap everything up. I want to thank you guys all very much for your questions. This was a very enjoyable presentation for me today. I love the dialogue back and forth, and I certainly hope that you learned a lot. Remember, our job as custodian is to kind of help you navigate, but at the end of the day, it's up to you to understand how your individual investments work, what they look like, and what the tax liabilities are. But we want to be as great of a resource as we can to you through this process. So just let us know how we can help. All the best to everybody in all your future investments, and look forward to working with you all. Take care.